Welcome back to Silver and Metal IQ. I'm Peter, and today we're diving deep into a topic that could redefine your understanding of gold and silver markets. If you've been following the headlines, you might think silver and gold are just fluctuating like they always do, but the truth is far more profound. What's happening right now is not just a market move, it's a structural shift in global finance, one that is quietly favoring those who hold real physical metals over paper contracts. We're at a point where sovereign nations and industrial giants are accumulating silver and gold aggressively, often prioritizing physical delivery over speculative trading. The United States, China, and the BRICS nations are not just buying. They're strategically integrating gold into trade settlements, vault expansions, and international finance systems, signaling a move away from traditional dollar-denominated instruments. Imagine a world where gold replaces debt as the primary settlement vehicle. That is no longer theory. It's starting to happen. But here's the hook. While the physical markets in Asia, the Middle East, and India are paying premium prices for real silver, Western exchanges still rely heavily on paper contracts. This creates a hidden tension between real demand and artificial pricing, and it's this gap that savvy investors can exploit if they understand what's really going on. The opportunity isn't in chasing headlines, it's in recognizing who is really standing for delivery and what that means for the price of silver and gold in the coming months. In this series, we'll explore why physical demand is dominating price discovery, how margin hikes and leveraged positions affect Western exchanges, and why countries like China and India are quietly cornering the market on critical metals. By the end of this series, you'll understand why holding physical silver isn't just an investment. It's a strategic move in a rapidly changing world. Before we dive deeper, make sure you subscribe to Silver and Metal IQ and turn on notifications, because what we're about to cover could change how you think about precious metals forever. Get ready to see why the next wave of wealth isn't being made in paper markets, but in physical silver and gold, and why understanding the flow of these metals is more important than ever for anyone serious about protecting their assets. Where we take a closer look at the global forces quietly shaping the silver and gold markets. What many retail investors don't realize is that we're no longer dealing with just speculative traders and hedge funds. Today, entire sovereign nations and industrial superpowers are strategically accumulating precious metals with a level of coordination and sophistication that dwarfs traditional market participants. The United States and China, for example, are treating gold and silver as critical assets, not just commodities. They're integrating them into trade settlements and even building physical infrastructure, like vaults across the Belt and Road Initiative, to ensure they control supply at a national level. The Shanghai Metals Exchange expansion is a prime example. China isn't simply trading on paper. They're creating a network where gold and silver can settle real-world trade balances without relying on U.S. treasuries. This strategy is part of a broader global pivot. Countries like Saudi Arabia, India, and the Gulf states are actively prioritizing physical metal accumulation to secure energy, technology, and industrial supply chains. By doing so, they are dismantling the dominance of Western paper markets and creating a new reality where physical metals, not derivatives, determine global pricing and scarcity. This shift is critical because it exposes a hidden truth. Physical demand now dictates market dynamics. Unlike leveraged traders who can be forced out by margin calls, sovereign powers and industrial buyers operate with cash, long-term strategy, and logistical capability. Their accumulation doesn't just move prices, it reframes the market. For example, China and India are buying vast quantities of silver at premiums well above Western paper prices, signaling that the true cost of the metal is far higher than most investors realize. This isn't speculation, it's strategic procurement, ensuring they have the supply needed for advanced technology, energy infrastructure, and national security. What does this mean for smaller investors? The key takeaway is that opportunities are created when real physical demand outpaces supply. Western exchanges, largely paper-based, may temporarily suppress prices through leverage and margin mechanics. However, these measures can't change the reality of physical scarcity. Anyone paying attention can see the trend. Those with access to physical silver, whether governments, sovereign funds, or industrial players, are quietly absorbing metal that will eventually drive global prices higher. As we move forward in this series, we'll break down how paper versus physical markets interact, why margin hikes and leverage shorts can no longer control silver, and how retail investors can understand the signals that point to long-term price trends. The global landscape is shifting, and understanding who holds the power and the physical metal will determine who thrives in this new precious metals era. The mechanics of the silver and gold markets have changed dramatically over the last few years. Historically, Western exchanges like COMEX and LBMA relied heavily on paper contracts, allowing traders to speculate without taking physical delivery. This created a system where prices could be manipulated through leverage, margin adjustments, and short positions. Today, that dynamic is shifting fundamentally. Sovereign powers, industrial giants, and well-capitalized investors are increasingly standing for delivery, demanding physical metal rather than settling on paper claims. This shift is exposing the limitations of a system built on paper and leverage. Margin hikes, a common tool used by exchanges to control volatility, are no longer just a way to curb speculative risk. They're part of a mechanism to protect the system from delivery defaults. When silver or gold prices rise too quickly, exchanges increase margin requirements, forcing traders with leveraged positions to either liquidate or post additional capital. While this suppresses paper price spikes temporarily, it does nothing to affect those operating with cash and access to physical metal. Sovereign buyers and industrial users are largely immune to these margin calls, meaning that volatility often just shakes out weaker hands, while consolidating real ownership in the hands of long-term, strategic holders. This creates an important divergence between Western paper markets and Eastern physical markets. In places like China, India, and the Gulf states, silver and gold are trading at premiums compared to COMEX or LBMA. These premiums aren't arbitrary. They reflect real supply-demand constraints, logistical bottlenecks, and a race to secure physical metal for technology, infrastructure, and energy projects. When these markets pay significantly more for the same metal, it signals a structural imbalance. The true cost of acquisition is not reflected in Western paper pricing, and the eventual convergence will likely push global spot prices upward. Another key element is the role of sovereign accumulation in breaking market suppression. In the past, leveraged traders and hedge funds could be forced to liquidate through margin pressure, temporarily capping prices. Today, countries like China, India, and the US are absorbing large volumes of physical silver and gold, effectively neutralizing the impact of paper market interventions. When major bullion banks fail to deliver, the system no longer collapses. It simply transfers ownership to deep-pocketed buyers who are indifferent to short-term volatility. The takeaway for investors is clear. Price volatility does not equal risk when real physical demand dominates supply. While short-term corrections will happen and paper markets may attempt to suppress spikes, the underlying scarcity of deliverable metal ensures that strategic accumulation drives long-term trends. Understanding this shift from paper dominance to physical priority is essential for anyone looking to navigate the silver and gold markets intelligently. While much of the media focuses on price swings, the real story behind silver and gold lies in industrial demand and strategic scarcity. Silver is not just a precious metal for investors, it's a critical component in modern technology, including solar panels, semiconductors, medical devices, and military applications. Governments and large industrial players understand this, which is why they are prioritizing physical accumulation ahead of retail markets. Unlike paper contracts, these purchases are about ensuring access to the metal itself, not speculation. Over the past several years, mining production has consistently failed to keep pace with demand. This isn't a temporary shortage, it's a structural deficit. Many of the above-ground stocks of silver exist in locations that are logistically difficult to access or require costly processing. As a result, any surge in demand, whether from sovereign buyers or industrial users, immediately tightens the market. For example, countries like China and India are actively buying physical silver at premiums, signaling that real-world scarcity is driving prices, not just market sentiment. Export controls and supply restrictions further exacerbate this scarcity. Since the start of the year, China has limited silver exports to prioritize domestic needs. Similar moves are being implemented by other nations to secure critical materials for infrastructure projects and technological development. These measures create a premium on physical metal in Asia and the Middle East, while Western paper markets lag behind in reflecting true supply-demand dynamics. This is a warning signal for retail investors. When real demand outstrips supply, waiting for a market correction may mean missing out on acquisition entirely. Strategic scarcity also means that those with deep pockets and access to global networks, sovereign funds, central banks, and major industrial corporations are absorbing metal before smaller investors can participate. Unlike retail buyers, they are not influenced by margin calls or temporary price corrections. They operate with cash, long-term strategies, and logistical capabilities that ensure they always secure what they need. For investors trying to understand market dynamics, this shift from speculative dominance to physical priority is critical. The metals market is no longer just about short-term trading. It's about ownership of tangible assets that underpin industrial and geopolitical power. Moving forward, the silver and gold markets are undergoing a silent transformation. Supply constraints, export controls, and strategic accumulation are redefining price discovery. Retail investors who ignore these factors may find themselves on the sidelines, watching as prices adjust to reflect the true scarcity and industrial value of these metals. Recognizing this trend now can help investors position themselves strategically, whether through physical holdings, bullion coins, or exposure to mining operations that will benefit from rising demand. As we continue analyzing the silver and gold markets, one of the most important indicators to watch is the gold-to-silver ratio. Over the past year, this ratio has collapsed dramatically from around 100.1 to roughly 50.1, signaling that silver is outperforming gold at a historically significant pace. Understanding this shift is crucial for investors because it highlights the rotation of capital from perceived underperforming assets to those poised for long-term gains. Historically, during major precious metal cycles, like 1933 and 1980, the gold-to-silver ratio compressed to levels far lower than today, indicating that silver historically tends to lead during bull markets in metals, often outperforming gold multiple times over. This means that even if silver experiences short-term volatility, its long-term trajectory remains strong relative to both gold and fiat assets. Another key metric is the Dow-to-gold ratio, which compares stock market valuations to the price of gold. Currently, this ratio is still well above historical lows seen at previous credit cycle bottoms, suggesting that equities remain expensive relative to hard assets. Investors should understand that these ratios are not just numerical curiosities. They reflect capital's shift in preference from paper assets to tangible, intrinsically valuable metals. As Mario Innecco has repeatedly pointed out, these ratio compressions are early signals of structural market realignment rather than simple speculative swings. When silver outperforms gold and the Dow-to-gold ratio remains high, it is a clear signal that precious metals are entering a regime of long-term accumulation and revaluation. The macroeconomic backdrop reinforces this trend. Central banks, particularly in the US and Europe, face structural constraints in monetary policy due to historically high debt levels. Even if policymakers attempt to tighten fiscal or monetary conditions, the system is heavily leveraged and reliant on continuous liquidity injections. Debt saturation mathematically limits the ability to maintain aggressive rate hikes or debt reduction without triggering systemic instability. For investors, this means that hard assets like gold and silver remain some of the few policy-agnostic stores of value capable of preserving purchasing power across a variety of economic scenarios. Political pressure on central banks adds another layer of complexity. Recent actions in the U.S., including investigations and public scrutiny over Federal Reserve decisions, have highlighted how central bank independence is increasingly vulnerable to external forces. Markets respond not only to inflation or interest rate changes, but also to perceived credibility and the willingness of policymakers to act decisively. Uncertainty over central bank actions makes precious metals more attractive as safe haven assets because their value is not contingent on the decisions of any single government or institution. Investors who understand this structural dynamic can better navigate volatility, knowing that metals are being driven by macro fundamentals rather than short-term headline noise. One particularly important theme is the asymmetry between retail access and sovereign or institutional accumulation. Large governments, central banks, and sovereign wealth funds consistently acquire physical silver and gold before it reaches the broader market. While retail investors often watch prices and speculate, the real buying power is concentrated in entities that control logistics, cash, and physical storage. This creates a structural scarcity for smaller investors. Even temporary market corrections or price dips should not be interpreted as opportunities to buy low in the traditional sense. Instead, retail participants should focus on dollar-cost averaging, stacking physical metal when possible, and recognizing the long-term scarcity trend. Global demand patterns also reinforce the investment thesis. Countries in Asia, the Middle East, and parts of Europe are actively tying precious metals to industrial and energy infrastructure, including solar energy projects, high-tech manufacturing, and national security reserves. This ensures that metals are not only financial stores of value, but also critical operational resources. When supply is constrained, as we have seen with export limits and logistical bottlenecks, premiums in Asia and the Middle East indicate that physical scarcity is already pricing in future demand, even if Western paper markets lag in reflecting this reality. For investors, the takeaway is clear. Ignore the short-term noise of spot prices, margin adjustments, or paper market volatility. Instead, understand the underlying drivers: ratio compressions, macro debt structures, political risk, and sovereign accumulation. These factors collectively point to a long-term bull market in silver and gold, where physical ownership, strategic timing, and awareness of global dynamics outweigh simple trading strategies. The next few years may bring corrections, but those are temporary disruptions in a broader trend of revaluation and scarcity-driven growth. Moving forward emphasizes that the current precious metals cycle is structurally different from past cycles. Ratios are signaling leadership rotation, central bank constraints create policy-driven demand for metals, and physical accumulation by sovereign and industrial buyers is creating real scarcity. Retail investors must recognize that volatility is not the enemy. Missing opportunities due to inattention to supply-demand imbalances is the true risk. In the next part, we'll examine the societal impact, strategic investment strategies, and provide essential financial disclaimers to help viewers navigate this complex environment safely. One of the key themes emerging is that physical scarcity and strategic accumulation are the ultimate drivers of price, not paper speculation. Over the past few years, governments, central banks, and sovereign wealth funds have been quietly acquiring vast quantities of silver and gold, often at prices lower than what retail markets see today. This isn't about short-term gains. It's about securing critical assets for future industrial, technological, and geopolitical needs. As a result, any temporary dip in the market should not be interpreted as a signal to sell. It's often a transfer of ownership from weaker hands to those who will hold for the long term. Another critical aspect to consider is global demand asymmetry. Markets in China, India, and the Gulf Cooperation Council countries are paying premiums for physical silver because they understand that access to tangible metal is more important than price in the short term. This has created a divergence between Western paper markets and Eastern physical markets, with Asia effectively setting the pace for global pricing. For retail investors, this means that focusing solely on spot prices in London or New York can be misleading. Instead, observing premiums, supply restrictions, and industrial procurement provides a much clearer picture of where the market is heading. Supply constraints remain another driving factor. Mining output has struggled to match global demand for years, and much of the above-ground silver exists in hard-to-access locations or requires expensive processing. Combined with export controls and domestic prioritization policies, this creates a tight market where physical silver and gold are not easily replaceable. Even as paper markets attempt to suppress volatility through margin hikes or regulatory adjustments, the underlying reality is that metal continues to flow into long-term holders' vaults, leaving less available for speculative traders. From a strategic perspective, retail investors should consider dollar-cost averaging and stacking physical metal whenever possible. This approach mitigates timing risk while ensuring consistent accumulation over time. Selling silver or gold to chase short-term fiat gains often means missing out on the structural appreciation driven by scarcity, industrial demand, and geopolitical positioning. The current cycle is not a typical speculative rally. It is a reconfiguration of global ownership and recognition of metals as sovereign and industrial assets. Historical patterns show that precious metals frequently outperform paper assets during periods of monetary expansion, fiscal stress, and declining confidence in fiat currencies, and the current environment matches these conditions closely. It's also worth noting the role of ratios in guiding strategic decisions. The gold-to-silver ratio, currently at roughly 50.1, indicates that silver is historically undervalued relative to gold. For investors seeking exposure to both metals, this may justify rebalancing portfolios to capture potential upside in silver while maintaining a hedge in gold. Similarly, the Dow-to-gold ratio suggests that equities remain expensive compared to tangible assets, reinforcing the case for metals as a portfolio stabilizer and wealth preservation tool. Understanding these ratios allows investors to align allocations with structural trends rather than reacting to market noise. Finally, it is essential to recognize that volatility is part of this market's nature. Price swings, margin adjustments, and temporary corrections do not undermine the fundamental trend. The world is moving toward greater demand for physical metal, constrained supply, and strategic accumulation by sophisticated buyers. Retail investors who remain patient focus on acquiring physical assets and avoid overreacting to short-term market manipulations are best positioned to benefit over the long term. Financial disclaimer: all content presented in this video is for educational and informational purposes only. Silver&Metal IQ, including its hosts and contributors, does not provide personalized financial advice, investment recommendations, or guarantees of future returns. Investing in precious metals, commodities, and related markets involves risk, including the loss of principal. Viewers should conduct their own research, consider their financial situation, and consult with a licensed financial professional before making any investment decisions. Historical performance is not indicative of future results, and past trends may not continue in the future.